Hello and welcome to Beyond the Charts, a show where we dive into fascinating charts from the world of finance and the economy, breaking down what's really going on. But before we begin, we've got an exciting announcement. Remember the name suggestion contest from our last episode? Well, we're here to reveal the winners. We promised a special gift for the person whose name we picked and for the funniest suggestion we received. So, a big shout out to Kshitij for coming up with the winning name Beyond the Charts. And thank you to Mitesh for cracking us up with the funniest entries. Now, coming to the first story. Silver has been on a roll. Earlier this month, it hit the rupees 100,000 per kg mark and is up over 30% this year, outperforming both gold and Nifty by a wide margin. Now, comparing Nifty and silver might feel like comparing apples to oranges, but when something is shining, people want it in their portfolios. So the comparison is hard to ignore. But how has silver performed as an investment? While gold and silver have similarities, they are not the same. Gold has predominantly been used for jewelry and investment purposes. It's traditionally been a store of wealth. Central banks across the world rely heavily on gold for reserves, as we showed in the previous episode. Silver, on the other hand, is a hybrid metal. It's used for both investment and industrial uses. Roughly 50% of silver demand comes from industrial applications in electronics, semiconductors, solar, and more. The other 50% is driven by investment purposes. In comparison, only about 5% of gold demand is industrial. Silver often follows gold's trends. It's considered a high beta version of gold, meaning it tends to be more volatile but also offers greater potential for gains. Since a significant portion of silver demand comes from industrial uses, silver's price is also influenced by the overall health of the economy. If the economy is doing well, demand for silver from industrial users will increase, which can further drive up the price. Coming to how silver has performed as an investment, it hasn't been all that impressive, as you can see from the chart. It shows returns for Nifty, gold, and silver from 1999, and silver has lagged behind quite a bit. In fact, over the last 25 years, silver has outperformed Nifty and gold only on 6 occasions. So while silver can have brief moments where its price shoots up dramatically, it often follows these with long periods where it performs poorly. Though gold shows similar patterns, silver tends to be much more unstable in its price movements. When prices fall, silver typically falls harder than gold, what investors call drawdowns or peak to trough declines, as we can see from this chart. Now coming to the next story, diversification. Given that we're talking about assets and their performance, it also makes sense to take a look at the performance of diversified portfolios. This is particularly relevant now as large, mid, and small cap stocks are down between 5 to 6% in October, and investors are freaking out. When investing in markets, it's not wise to put all your eggs in one basket because if that basket falls, you have no eggs left. While everyone wants the highest returns by investing 100% in equities, that's not the right way to invest. When things are good, you'll get good returns, but when things are bad, you'll get hurt. For example, Nifty 50 was down by about 58% in 2008. Diversifying your portfolio across multiple assets, equities, gold, bonds, and foreign investments is one of the best ways to reduce risk and shield your money from market swings. Think of it as finding the sweet spot. You get to participate in market gains while protecting yourself when markets fall. Remember the silver example we just discussed? It's highly volatile and you can go through years of poor performance. Would you risk all your savings on just one such asset? Probably not. This is where diversification becomes your best friend. By spreading your investments across different asset classes that behave differently, meaning they don't all rise and fall together, you're more likely to build lasting wealth over time. In fact, DSP Mutual Fund recently shared a fascinating chart in their newsletter that perfectly illustrates this point. It compares 20-year annual returns across various asset classes against a multi-asset portfolio. Here's a chart that breaks down the performance of equity, debt, and gold by calendar year. It shows that a diversified portfolio offers reasonable upside potential while helping limit losses during market downturns. While diversification may reduce your overall returns, it also reduces your risk. It's important to think about this trade-off holistically. A word of caution, people often look at historical charts and believe they can perfectly time the markets based on past patterns. In reality, it's far more difficult than it appears. Just because something performed well in one year doesn't mean it will follow the same pattern the next year. Here's another perspective. We ranked the performance of equity, debt, and gold each year. As you can see, the best performing asset class frequently changes. This is why investing in all of them is the smartest strategy. Every asset class has its cycles of underperformance. For example, equity was the top performer from 2006 to 2008 but delivered zero returns from 2008 to 2013. Similarly, gold dominated returns from 2008 to 2013 but then fell into negative territory from 2013 to 2018. As an investor, it's impossible to predict which asset will outperform or underperform or how long these cycles will last. As different assets have different returns and risk profiles, your asset allocation strategy significantly influences both your portfolio's returns and risk levels, as shown in this chart. A 100% debt portfolio offers the lowest returns with the lowest volatility, while a 100% equity portfolio delivers the highest returns but also comes with the highest volatility. As you shift your allocation from debt towards equity or gold, your portfolio's returns and volatility change dramatically. As an investor, your goal should be to find an asset allocation between equity, debt, and gold that you can comfortably maintain in the long run. There's no ideal portfolio. The best portfolio depends on your life circumstances, your age, your risk tolerance, and your capacity. More often than not, the best portfolio is the one that allows you to sleep well at night. Now, coming to the next story. How does India invest? Speaking of diversification, conventional wisdom long held that Indians were risk averse investors who put most of their money in real estate, gold, and fixed deposits. While this remains true, the pattern has begun to shift over the past decade. According to a Jefferies report of India's $12.8 trillion in household savings, 51% is invested in property, followed by gold at 15%. Equities, in contrast, account for just 5.8% of total investments. What's fascinating is the steady growth in the number of Indians investing in stocks and mutual funds with a significant acceleration after the pandemic. Motilal Oswal recently shared some interesting statistics about Indian households' participation in the stock market. Households now own 22% of all listed stocks in India, up from 15% in 2013. And this figure doesn't even include mutual fund investments. When we compare the direct and indirect exposure of the household sector through stocks and mutual funds, Indians now hold investments worth rupees 134 lakh crore, which is $1.6 trillion. This accounts for about 44% of the country's GDP. In comparison, most advanced economies, excluding the US and Canada, have household investments ranging between 30% and 55% of GDP. In the US and Canada, however, household investments exceed 100% of GDP. Compared to other markets, Indian households hold 21.5% of the stock market, second only to the US, where the share stands at 39.6%. The share of mutual funds, NPS, and other investments in household savings has jumped from 17% in 2019 to 28% in 2024. This highlights how mutual funds have been instrumental in helping millions of Indians kickstart their investment journeys. In fact, the household sector, covering both retail investors and high net worth individuals, now owns about 63% of the total mutual fund industry's AUM in 2024, up from 55% in December 2019. Now, coming to the next story. Food is still very hot. India's consumer price inflation, or CPI, is on the rise again. If you're not familiar, CPI measures inflation by tracking the average price changes of a basket of goods and services over time. In simple terms, it tells us how much more expensive everyday essentials have become for the average household. After easing to around 3.6% in July and August, inflation jumped to a 9-month high of 5.5% in September. The drop in July and August was mainly due to what's called a favorable base effect. This happens when current inflation looks lower compared to the same time last year because prices back then were already quite high. But now that this base effect has faded, inflation is creeping up again. The key reason behind the September spike? A surge in food prices. See, food items carry the most weight in the CPI basket, about 45.96%. That's why when food prices go up, CPI inflation tends to follow. In September, food inflation shot up to around 8.4%, mainly driven by rising prices of vegetables, pulses, and fruits. The prices of vegetables, pulses, and fruits have stayed high due to unfavorable weather conditions like heat waves, unseasonal rains, and even monsoon rainfall. For instance, in September, vegetable prices surged by 36% compared to around 11% in August. The hope now is that favorable monsoons will help cool down food inflation and in turn bring down overall CPI inflation. However, the RBI made it clear in its recent policy meeting that it won't consider cutting interest rates until it's confident inflation is under control and below its 4% target. This cautious stance comes despite the fact that the US recently cut rates by 0.5%. Now, coming to the final story, outward remittances on the rise again. Outward remittances, funds sent out of India under the Liberalized Remittance Scheme or LRS, have been gradually picking up over the past few months. After peaking at around $3.8 billion, roughly rupees 32,000 crores, they had dropped to about $1.8 billion, around rupees 15,000 crore in November last year. The LRS allows resident individuals to send up to $250,000, approximately rupees 2 crores, abroad for specific purposes like travel, investments, medical treatment, studies, and more. Foreign travel makes up the largest chunk of remittances. In August, out of the $3.8 billion in total remittances, about $2 billion or around rupees 16,800 crore was transferred specially for travel purposes. Interestingly, more Indians are now sending money abroad to invest in things like US stocks, ETFs, and other global assets. One key reason for this surge is that the RBI has set a $7 billion or around rupees 58,800 crore cap on overseas investment by Indian mutual funds, and the industry has already hit that limit. As a result, many international mutual funds have stopped accepting new investments. This has led some Indians to open online investing accounts to directly invest in international stocks, ETFs, and more. That's all for today. Thank you for watching. If you have any feedback on where we can improve, please do let us know in the comments below.